Okay, so we are finished with the first, second, so the two segments of the course, and we're now into the last segment. Okay, so the first segment was what you did for the first midterm. We talked about fundamentals, terminology, just getting a feel for different types of cost behaviors and so on. The second segment, which is what you're going to wrap up on Thursday with the test, was costing. Right, just sort of the fundamental techniques that you learn really that you learn and use as a managerial accountant. Now the third segment is going to be a significant change of pace. Okay, so that's good news to some of you that didn't like costing so much. But what the first topic we're going to deal with is making budgets, making and using budgets for planning and for control. These are two very distinctive settings in which budgets are used. Once we finish up with budgeting, we're going to learn some specific techniques for decision making in two contexts: short-term decision making and long-term decision making. And you might ask what the distinction is. The distinction derives from the fact that costs behave differently in the short term than in the long term. Okay? To quickly remind you of something that we spoke about at the very beginning, in the short term, many more of your costs are fixed in nature because you can't do anything about them in a short period of time. You've already committed to incur them, and now you can't get out of the lease or change the contract or whatever it is. But in the very long term, more and more of your fixed costs start becoming variable because you can change things. You can renegotiate your lease, you can change your contract, you can decide to let the space go, let the person go without any consequences. Okay, so cost behavior is fundamentally different, so we need to look at these two types of time periods in a very different way. But for the time being, we're going to talk about budgeting. Now, the term budgeting is one that we are all familiar with, right? We use it very often in conversation, right? So, someone describe to us what a budget means. So typically, some kind of it has to do something with expenses, and it's kind of like an upper floor and on what you can spend. It's usually determined by how much money you have, right? What other contexts have you seen budgets in, or have you seen budgets being talked about? Governments have budgets, right? And they have to balance their budget. So somewhere around the end of the government fiscal year. Does anyone know when the government fiscal year ends? Usually in June. The corporate fiscal years mostly end in December, and the government fiscal years end in June. This is nice for the accounting firms because they can spread their work out over the course of the year. So governments typically need to balance their budgets, right? So this is about the time of the year when they start deciding to cut things, to cut expenses and so on. So I think government budgets also relate to more about, you have a certain pot of money and how do you balance out all your expenses to make sure that everyone that needs to get paid gets paid. Now, in a corporate sense, a budget means something broadly similar, but it involves more components. Budgeting is not simply about deciding how much you can spend. It's something broader, something larger than that. A budget in a corporate sense is simply a quantitative expression of your plan. Okay, where we use a plan in a very conversational sense. So a plan is simply a statement or a description of how you intend to achieve certain goals, right? And a budget is a quantitative expression of your plan. So suppose your plan is to become the market leader in a particular product segment. Okay, that's your objective, and you plan to do that by, let's say, rolling out some new product innovations in the next 6 months to 1 year and so on. A budget will take that general intention, right, and will translate that into specific numbers. Okay, how many new products do we expect to roll out? Exactly how much in revenues do we target for the end of this year? Exactly how much expenditure do we have to put into R&D in order to meet that revenue target? Exactly how much do all our costs have to come in under in order to achieve that particular growth in income that we have in mind? Okay, so budgets have a few elements to them. They are quantitative, first of all. Okay. They are quantitative expressions of plans, and plans always relate to the future. So a budget always relates to a specific period of time in the future. Okay? Typically, an annual corporate budget will deal with an accounting period, which is usually 1 year. So you'll very often see a budget for the period beginning the 1st of January 2012 and ending the 31st of December 2012. And it might be broken up into smaller budgets that last only, let's say, a quarter or even a month. Okay? Now, many of us tend to think about budgeting as a more or less a mechanical exercise. Okay, and you shouldn't. It's a very integral part of the strategy making process. Okay, we talked a little bit about strategy in the first week. So a strategy, again, is a very intuitive kind of word. It's simply a description of exactly how you plan to achieve your objectives, right? So your objective is to become the market leader or the highest market value company in some segment. Your strategy to achieve that objective might have something to do with product innovation and introducing new products and or creating a new market for some new kind of product and so on. And so this kind of strategy is typically made at what level in the organization? It's typically made at the top level in the organization in what we call the C-suite. Okay, has anyone heard that term, the C-suite? So you know that the top executive in a firm is referred to as the CEO, right? The Chief Executive Officer. He's supported by a bunch of other Cs. The Chief Financial Officer, or the CFO, is one. He's the guy in charge of finance. The COO is another one, the Chief Operating Officer. And then depending on the needs of the firm, you might have a CTO, who's a technology officer, and so on. So all of these guys are jointly referred to as the C-suite. Okay, so strategy is typically made at the C-suite level, right? And any kind of strategy is usually backed up by a strategic budget. Okay, so there's a budget that takes that strategy, which is a general statement of what you are going to do and translates it into specific numbers line by line. Okay, so hammers it down very specifically. The strategic plan is then taken and is translated into what we call a tactical plan or a series of tactical plans. Okay, that spell out in even greater detail exactly all the steps that need to be done in order to achieve every sort of broad link in your strategy. And a tactical plan is something that you can give to your middle managers that they can actually work with. So it might contain more specific goals, less general goals, more easily monitorable targets over shorter periods of time. And the tactical plans will be accompanied again by tactical budgets. Okay, and then finally you take the tactical plans and you translate them into operational plans, which are very specific instructions to the lower level employees in the organization as to exactly what they need to do, such that the sum of all the parts from the lower half of the organization comes together to form the objective or the strategy. And again, operational budgets. Okay, so the process of budgeting is really just the process of taking strategy and translating it into numbers. It's a very integral part of the strategic process. Now, any well-managed, well-organized company will go through an annual budgeting cycle. Okay, at least an annual budgeting cycle. It will probably be for shorter periods of time than that. Also, there will be half-yearly budgets and quarterly budgets and so on. Okay, but an annual budgeting cycle has a few steps. So the beginning of typically of the fiscal year, nobody gets any work done for the first month because we're doing budgeting. Okay, so you come up with your plans, you translate them into numbers, you formulate the strategic, the tactical, and the operational plans, and then you communicate from those plans the expectations of the plans involved to everyone at different parts and at different levels in the organization. Okay, and once you communicate the expectations that the budget comes with, you put into action all the different steps that you've decided to take. Now, the budgeting process does not stop there. Okay, now most people think that planning or budgeting ends with implementing the plan. That's only half of the story. Okay, once you implement the plan, then the second phase of the cycle starts, which we call the control phase. Okay, now control is basically everything that happens once you have implemented a plan. Now what needs to happen once you have implemented your plan? You need to know if your plan is working, right? And there's a number of things that you need to do in order to ascertain that. Now, first of all, you want to decide, how am I going to measure success? Right? And this is not a straightforward thing. You might measure success in terms of income growth, maybe sales revenue, number of new products, number of new customers, number of new markets, or cost efficiency, right, or profit margins, return on investment, and a number of metrics that you can, and you need to narrow down what metrics you're going to use. Then somebody needs to collect those metrics periodically, right? And then once you've collected those metrics on your actual performance, you need to take them and then compare them to the budgeted performance, right? Your budgeted performance is essentially what your budget spells out. That is your expectation about your performance. Compare the actuals to budget. When you compare your actuals to budget, there will invariably be some differences. Right? Rarely does it come about that your performance goes exactly as budgeted. Okay? There will invariably be some differences. Any differences between your actual performance and your budgeted performance we call a variance. Okay? This is a term that you're going to be working with extensively. So variance refers, V-A-R-I-A-N-C-E, refers to any difference or any variation essentially between budgeted performance and actual performance along any dimension. Okay, now variances can be of two kinds. They can be good variances and bad variances, loosely speaking. Right? A good variance essentially means something is going better than expected. A bad variance means something is going worse than expected, and you can have both kinds. Right now, what do you do when you have a variance? Well, you have to investigate the reason for the variance. What is somebody doing in order to create, what is somebody doing differently? Or what is going differently than planned that creates this variance? Right? And if it's a bad variance, you find out a way to correct it, to correct your course and to get back onto your planned course. If it's a good variance, well, you find out what exactly is causing that good variance so that you can motivate somebody to do more of it, or you can get everyone else to do what this person is doing, so you generate more of the good variance. And once you've had experience with this entire cycle, and then you go back, and next year when you're making your plans and your budgets again, you can incorporate all of this experience into creating your new plan. That's why people sometimes call it a planning and control cycle. Okay, so you can't have everything that an organization does over the course of a year actually can be encapsulated in the planning and control cycle. Okay, but you can't have this cycle without a budget, right? Because you understand you can't evaluate performance unless you put some numbers down. It's very difficult to evaluate performance qualitatively because you don't get a specific enough grasp on what's going on. Okay, so at the heart of all of this something that we call a master budget. Okay, the master budget is really sort of the key document, the key output that comes out of the annual budgeting cycle. So typically what you've seen in financial accounting, you've seen over the course of a period how transactions accumulate up, they add up, and at the end of the period the financial accountant sits down and sorts out those transactions into an income statement, a balance sheet, and a cash flow statement, right? Now that's what so you see only what happens at the end of the period. Now there's an equivalent process that happens at the beginning of a period. So let's suppose we just came to the end of 2011, you prepared all of those financial statements. Now the beginning of 2012, you take all of that past history and any information you may know about the future, anything that you know is going to be different in 2012, and you translate that into a budgeted income statement, a budgeted balance sheet, and a budgeted cash flow statement for 2012. Okay, so really in financial accounting you only saw one end of the process, but it's a two-sided process. At the beginning of every period, you start out with a budgeted set of financial statements. At the end of the period, you come up with your actual, and there you have it, your expected and your actual performance. You can do your variance analysis, and hopefully you should do variance analysis in between too, instead of waiting until the end of the period, right? But loosely speaking, there you have it both sides of the process. So it's a very symmetric kind of process. So your master budget really consists of your budgeted income statement, balance sheet, and budgeted statement of cash flow. Now, the thing to realize that's important about the master budget is that you're planning both aspects of performance. Operational performance as well as financing. Okay. Now, what does this mean? What is operational performance and how is it different from your financial performance? So did you see the two as being unrelated? The resources of the firm from money. Do you see them as being unrelated? Or are they actually, because you describe them as if they were unrelated, right? So operational and financial, does anyone else want to try describing or distinguishing operational performance and financial performance? Now, you see this distinction in many places. There's a major called finance, there's another major called operations, right, or supply chain management. People often who work in the corporate world tell you, oh, I'm in operations or oh, I'm in finance. What does that mean? What aspect of the organization do you think they're working on? Okay. Okay. So let's start off with the operating part of it, right? Your operational performance or your operations relate to the core business that you are in, and this is going to be a different thing for every business. So, for example, if you are a widget manufacturer, your operations refer to the core process of actually assembling all the factors of production that you need in order to make that widget and to turn it out. So how you organize together your land, your labor, your machinery, equipment, technology, managerial skill, and all of that to actually produce your widget. So it relates to the core business that you are in, and it's going to be a different thing for every business because every business has a different kind of core value-adding proposition. Okay. Now, what is the financing side of your business? The financing side of your business relates to where are you going to get the money from in order to do the operation. Okay, because assembling all the factors of production, your land, labor, equipment, managers, etc., requires money, requires financing, unless you're able to finance all of the operations yourself, which only happens in very rare circumstances. One nice way of thinking about it is financing relates to the sources of funds, where you are going to go to get the money to invest in your inventory, people, machinery, etc. Okay? Your operations relate to the uses of your funds. Suppose you decide to raise financing from a bank, and the bank gives you $1 million loan. That's a form of financing. That's a financing strategy to finance your business using a bank loan. Then the operations people will come in and they will use that $1 million, put some of it into buying land, put some of it into buying equipment, hire some people, build up some inventory, and then actually start churning out the product that is going to generate value to the business. Okay, so two sides, you need one to have the other. And I don't know if it's occurred to any of you, but your balance sheet, which is really the most important document in the financial system, your balance sheet neatly summarizes both sides. Okay? Now, if you want to think about your balance sheet the traditional way, you have assets on the left-hand side, you have liabilities and equity on the right-hand side. One side relates entirely to the financing part of your business, and the other side relates entirely to the operations part of your business. Which to which? Yes, the liabilities and equity side of your balance sheet reflects your financing strategy. If you have more liabilities, for example, that means you decided to finance largely through loans or lending money. If you had more in equity as opposed to liabilities, you decided to rely on getting money from equity investors and not relying too much on loans. So that reflects your financing strategy. What the left side of your balance sheet, the asset side, looks like reflects your operational strategy, because your assets are entirely things that you invest your money in, right? Inventory, receivables, machinery, land, buildings, etc. So that's a nice way to think about it. Okay, so this is, so be aware of the fact that this process, that your entire annual period is sort of bookended by a budgeted set of financial statements at the beginning and by an actual set of financial statements at the end. And you don't have to think about it as an annual thing, right? Anytime you have an annual accounting period that's broken up into smaller periods, quarterly, and the quarterly is broken up into monthly and so on. So just like you have a budgeted financial statements at the beginning and at the end of the year, you will also have budgeted and actual statements at the beginning and end of every period. So making your budget and comparing them to actual performance is a very periodic thing. It happens every quarter, every month, depending on the organization. Okay? Before we kind of jump in full tilt into actual variance analysis and so on, I want to just sort of discuss with you some of the value that we get from making budgets. So the best way to think about it is really imagine you were a business owner and you didn't do any budgeting. James, you opened your restaurant in Newark, and now you're at the end of your first year of keeping the business open, and you had no budget, no plan to start out with. Okay, so really thinking about that kind of situation gives you a best idea of what the value is of having a budget in the first place. So let's first, very simple use or value that you get from having a budget is that you set expectations at the beginning of the period. And just by giving out that budget to everyone, you communicate those expectations to everyone. Right? So particularly in a large organization, this can be a significant thing because there could be people at different levels and at different parts of the organization that don't know, unless they see the budget, that this is the revenue target that we need to meet, for example, or this is the cost efficiency target that we need to meet. So primarily, it's a communication device, and it's also a coordination device because it makes sure that everyone is working towards the same set of expectations. Now, think about being a restaurant owner at the end of your first year and you don't have a budget, okay? Let's say you made $10,000 in profit, okay? So the question is that good, bad, or just mediocre? You don't know, right? So we've mentioned this particular concept many times in class, right? Anytime you want to evaluate your performance, and evaluating performance means looking at a metric of performance and making a judgment about whether it's good, bad, or mediocre, right? You cannot make an evaluation unless you have a benchmark of some kind. Right, so suppose we're discussing corporate performance in different companies. This is the earnings season. This is the time when everyone's announcing their annual earnings. And tell you that Apple made $1 billion this year, right? They actually made like 80 times of that, but never mind. So they made $1 billion this year, right? Again, is that good, bad, or mediocre for a company of its size? Well, you don't know. You need some expectations or some benchmarks to put that number against, and then you can make an evaluation. Now, typically, when we are looking for benchmarks, there are two common types of benchmarks that we all tend to use. Okay, what are they? So suppose you are trying to evaluate the performance of Apple, right? The profitability of Apple. And I'm asking you to look for benchmarks that you would compare Apple against. Where would you go? There are two broad types of benchmarks. Okay? So those are the two broad types of benchmarks. Very good. So let's talk about the industry as a whole. That's what we call a cross-sectional benchmark. Okay? So this typically relates to comparing the performance at the same point in time of other firms that are similar to yours, or which are in a similar business, or of a similar size, and so on. Okay, you all know what a cross-section is, right, from biology. Okay, so this is an example of a cross-sectional benchmark. The other example that you gave us was what we call a time series benchmark. Okay? This is simply comparing the performance of Apple in 2011 to the performance of Apple in 2010, 9, 8, and so on. Okay, two very different types of benchmarks, right? Now, both of these benchmarks are valuable. And anytime you're making a serious judgment on performance, you should use both of them. But they both come with certain defects. Okay, somewhat obvious defects if you spend a little while thinking about it. What's the obvious defect with cross-sectional benchmarks? Yeah, there's always going to be some differences between you and your peer group. It is very difficult in real life, unless you're in a laboratory setting where you can construct simulatedly, identical peer groups. It's very difficult to find a company that is exactly doing the same thing as you are, right? So Apple is the perfect example. So some people could argue that the perfect peer for Apple is Microsoft. Now others would argue the perfect peer for Apple is Dell. Right? Someone else would argue that the peer group should include things like Google, Facebook. So particularly when you're dealing with large companies, they tend to be diversified. So they tend to be many different businesses at the same time. Right? And each firm tends to be diversified in a slightly different way. So it's very difficult to find an exact match for the competitor. Okay, so that's the problem with cross-sectional benchmarks. What's the problem with time series benchmarks? Changes in the environment, but more specifically, so let's just think of an example, right? Suppose last year, suppose we're in the year 2008, okay? Now, what's significant about 2008? I know many of you were in high school back then. The financial crisis, the banks, Lehman Brothers failed, and all of these other sort of catastrophic events that changed the world, right? So suppose you were in 2008, okay? Your performance at the end of the and you're an investment bank, your performance at the end of the year is going to be really, really bad, right? Now you recognize that you shouldn't use 2007 as a benchmark at that point in time, right? Because something in the environment has changed, and more importantly, a change has happened that is beyond the control of the people whose performance you're trying to evaluate, right? Because if there's a broad recession in the macroeconomy, that's not something that you can hold your individual managers responsible for, right? So naturally, when you're constructing time series benchmarks, you end up with these kinds of issues. That last year's performance might be extraordinarily good or extraordinarily bad because of factors in the environment that are beyond the control of the people that you're trying to evaluate, right? So this is precisely actually the reason why we construct budgets. If either of these two types of benchmarks were perfect, we wouldn't need to construct a budget in the first place because we could just use one of these other sources of information in order to judge our performance, right? But it's precisely because both types of benchmarks come with some problems that we construct our own internal benchmarks, which we call budgets, right? And so when you construct a budget, you can figure out ways to strip out the defects in both types of benchmarks, because you're basically using your own past performance as a guide, so you don't have the problem with cross-sectional benchmarks. But at the same time, if you were taking, for example, your performance from 2007, 6, and 5 to construct your budget for 2008, you would naturally make an adjustment, right, to the historical numbers to account for the fact that the environment today is very different and so on. Okay, so that's precisely what we do while making a budget. We're trying to create an internal benchmark that's better than either of these sort of natural benchmarks that exist. Okay, two basic types of budgets that vary by the kind of time frame. Okay. Traditional budgets and rolling budgets. Okay, and they're best understood really by the difference between the two. So traditional budget is what was in use, as you can tell from the term, for a very long time. It's a budget that lasts for a fixed period of time. Okay, so let's say we're doing an annual budget from the 1st of January 2010 to the 31st of December 2010. What happens on the 31st? Your budget expires. You replace it with a new one that starts on the 1st of January of next year. So that's traditional budgeting. Now, rolling budgets work very differently. So With rolling budgets also, let's say you start out with okay, so it starts out looking exactly the same as a traditional budget. Let's suppose you were doing monthly rolling. If you were doing monthly rolling, you would do the following. When 1 month has expired and you come to February, you roll the entire budget forward by a month. So then you replace that old budget with a new budget that goes from the 1st of February 2010 to the 31st of January 2011. You basically roll the window of the budget forward if you're doing monthly rolling. And then next month you roll it forward by another month. That means you now have a budget that goes for this period and so on. Okay? Everyone might not do monthly rolling, you might do quarterly rolling. If you did quarterly rolling, you would only roll the budget forward every 3 months by 3 months at a time. Okay? Now, so that's superficially the difference between the two. Now, why would we prefer to do a rolling budget over a traditional budget? And why might we not prefer to do a rolling budget to a traditional budget? The second question is actually easier to think about. Yes, that's precisely right. So that's a big advantage of a rolling budget, because think of the following. Imagine you had a traditional budget and this was, let's say 2008, or for that matter any other year, but 2008 more stark than the others. Okay? So you start out and then let's suppose you are now in the month of September. Everything was going swimmingly until then, and then in September all hell breaks loose, and then we have a financial crisis, and it looks like the whole financial system is going to break down overnight, and then things are really bad after that point. Okay? So in a traditional budget, what happens is, as you get towards the end of the budget, the information that's in the budget starts becoming obsolete or dated or irrelevant. So you start working with benchmarks now that are not meaningful given the current circumstances, right? And this particularly becomes a problem as you get closer and closer to the end of the budgeting period, right? Whereas in rolling budgets, what are you doing? You're constantly updating your expectations. You're always working with benchmarks that are fresh and that are meaningful given the current circumstances. So that's one huge advantage. There's another advantage of rolling budgets. To think about that, I want you all to reflect back on the group discussion exercise that you did at the end of the first week. Anyone remember the group discussion exercise you did at the end of the first week? I know, it seems like ages ago. Yes, yes. Do you remember the context to that exercise? At what point in time were those actions being contemplated, and why were they being contemplated? So this was a company that had achieved a certain earnings growth every year for a certain number of years, okay, and this year it looked like they might have to miss that target, okay, so it looked like they were going to underperform this year, and because of that the CEO was thinking of doing certain actions at the end of the year in order to basically manipulate your performance a little bit such that you would meet the budget this year. But a natural consequence, so it involves doing things like, you can all visualize, taking next year's revenues and moving them into this year, taking this year's expenses and pushing them out into next year, and so on, right? Now, naturally it makes current year performance look better at the expense of what? At the expense of next year's performance. You're moving revenues forward, you're pushing expenses out. So next year you will have to do the same thing but a little bit more in order to keep up to the same standard that you set for yourself in the current year. Okay? So this is a natural instinct, a natural temptation with traditional budgets, because the budget is going to expire on a particular day and time. So whatever it is that you want to do, you had better get it in by that point in time. So a traditional budget creates those incentives for manipulation towards the very end. Can you do that with a rolling budget? It's very difficult because the budget never really expires in a sense. You always have a window of 12 months ahead of you. okay, for the budget. So those incentives are significantly less with a rolling budget. Disadvantage of a rolling budget is very straightforward. It's a lot more work than traditional budgeting, but as we all know, no pain, no gain. Okay, so rolling budgets are kind of becoming the industry standards now everywhere. But for the purposes of the class, okay, when we actually prepare and use budgets for variance analysis, we are going to work largely with traditional budgets. We're not going to try and roll our budgets forward. Okay. So we finished talking about some of the concepts and some of the terminology that you should know, and I want to jump right ahead into the sort of second. So your chapter, if you notice, is called Budgets for Planning and Control. Okay. So the second part of it is what we're going to spend a lot of time focusing on, which is using budgets for control. Okay. So that is, how do you prepare budgets, and then how do you use them for variance analysis, which is a big part of control. So taking a budget, taking actual performance at the end of the period, comparing the two, figuring out what your variances are, analyzing the reasons for your variances, and coming up with a list of steps that you should take to correct the issues. Okay. So if you would turn to so there are some concepts there that you can read on your own, mostly definitions. If you would turn to page 7, please, I'm going to talk about budgets as a control device. Okay, so we already talked a little bit about what we mean by control. Control refers to everything that happens after you implement your plan. So you first decide how you're going to measure success, list out the metrics, collect all of those metrics, compare the actuals to the budget, figure out what your variances are, sort them out into good variances and bad variances, find a way to fix the bad variances, find a way to reinforce the good variances. That's essentially what we mean by control. Okay, so a few pieces of terminology that you want to be very familiar with. The first one we already introduced. A variance is any difference between an actual number and the budgeted version of that number. Okay, so it could be an actual revenue compared to budgeted revenue, so that's a revenue variance. An actual cost compared to budgeted cost, that's a cost variance. Actual overheads compared to budgeted overheads is an overhead variance, and so on. So any actual number minus the budgeted version of that number is what we call a variance. Okay, so there's a very simple example here. Umbrellas Incorporated budgeted to sell 10,000 umbrellas last year. So this is just a sales volume quantity, it's not a dollar quantity. They only ended up selling 8,000 umbrellas. So what is the variance here in numbers? It's 2,000. Okay, now anytime you express a variance, there are two pieces of information that you need to provide. The first piece of information is the number, or the magnitude of the variance. The second piece of information you need to provide is the direction of the variance. And the direction of the variance can either be a favorable variance or an unfavorable variance, and you need to specify both the magnitude and the direction of a variance in order to completely describe your variance. If you only give the magnitude, it's an incomplete way of describing the variance. Okay, so how do you distinguish between these two? A favorable variance is anything that leads to your final actual performance being, what do you think, better or worse than budgeted performance? Better, holding everything else constant. Okay, looking at only that particular component. An unfavorable variance is the opposite. Anything that leads to your final overall performance being worse than budgeted, holding everything else constant. So which of the two do you think this is? It's clearly an unfavorable variance. Okay, so you would just say 2,000 U, and you would be done. So if it were a favorable variance, you say 2,000 F. Now keep in mind, what is a favorable and what is an unfavorable variance mean opposite things for revenues and for costs. Okay, so suppose you had the following budget. this was actual performance. Okay? Now there are two variances that you can figure out here. You can figure out, actually three: revenue variance, cost variance, and your overall income variance. How much is your revenue variance? 1,001. F or U? U, because actual revenues are lower than budgeted revenues. So holding everything else constant, if actual revenues are lower than budgeted revenues, that generates poorer performance. Okay? Now, how about your cost variance? Now, what you have here is your actual costs being lower than budgeted costs by 600. So is that an F or a U? That's a favorable variance, because holding everything else constant, actual costs being lower than budgeted costs leads to better performance. So that's a favorable variance. So keep in mind, what's favorable and what's unfavorable means opposite things for a revenue as it does for a cost. Okay? You'll sort of reinforce this over practicing multiple times with many examples. So what we are going to do now is start. We're not going to be able to complete, but we are going to start a sort of comprehensive variance analysis case. Okay, and it spans actually 2 chapters of your textbook. So we're going to start out, we're going to put in the first level, and we're going to move on to do the following levels after we come back from the exam. So the case is the web company case. That's on page 7. So take a second and start reading that case. So the web company case, everyone found the case, right? Okay, so manufactures and sells jackets. For the period April 2006, cost information is given below. Okay, so we're going to do budgets for the period of April 2006. Assume that web sold all the jackets it made in that month and that it had no opening or closing inventory of jackets. So it's a very simple situation: no opening, no ending inventory, production equals sales. The jackets have 3 variable cost categories. The budgeted variable costs per jacket are as follows. Direct material is $60 per. Direct manufacturing labor is $16. Variable manufacturing overheads are $12. Okay, so 3 variable cost categories. Web budgeted to sell 12,000 jackets at a price of $120 per jacket, and budgeted fixed overheads for this range of output was $276,000. So you are given really enough information here to make an entire budgeted income statement. Okay, you can figure out budgeted revenues, you can figure out budgeted variable costs, and you are given budgeted fixed costs. Okay, so the very first thing I want to do is to prepare that budgeted income statement. So we're going to start out with revenues. What are your budgeted revenues? What are your budgeted revenues? Look at the information given and tell me what budgeted revenues are. 12,000 sales volume at the price of 120 jackets at $120 per each jacket sold. So your budgeted revenues are going to be 12,000 units times 120 per unit, right? Okay, now moving on. So that works out to some 1,440,000. Okay, so after that we're going to list out all the costs. We have some variable and some fixed costs, right? Okay, so let's deal with all the variable costs first. The first variable cost that you have is your direct material cost. So what is your budgeted direct material cost? So what's your budgeted direct material cost? Someone else, please. Look at the information given. You can't look at the board because the information is not there. Jennifer? Can you tell me the components, please? That's right. The direct material cost per unit is 60, and that gets multiplied into the budgeted volume of 12,000. Okay? So that gives you budgeted direct material cost of 720,000. And similarly for direct labor, similarly for variable overhead. Okay? So your budgeted direct labor costs are going to be, again, 12,000 units at a budgeted rate of, what is it? 16 per unit. Okay, and your budgeted variable overheads are going to be, again, 12,000 units at a budgeted rate of 12 per unit. Okay, so this works out to 192,000, and this works out to 144,000. What are your budgeted fixed overheads? $276,000. That's just given information. Okay. I'm just underlining all of these so that you can see them clearly. So finally, your budgeted operating income or net income, 1.44 million minus 720,000 minus 192 minus 144 minus 276. Okay, so you can calculate what that works out to. In this case, it works out to 108,000. So far it's just a matter of picking out the information and arranging it in the right place, putting it into the right order. So this is the very first step in any kind of variance analysis process, which is just figuring out what the original budgeted performance looks like. Okay, so now we get to the real variance analysis part of it. Okay. So now, at the end, if you keep reading, at the end of April 2006, the following data were compiled. Okay. Actual revenues for the period were 1.25 million, and the actual selling price was 125 per jacket. So our revenues as per budget. Are your revenues as per budget? A little bit higher than, no, a little bit lower than budget, right? But your selling price is actually a little bit higher than budget, right? So what can you infer from that? You can infer from that your sales volume must have been lower than budget. Actual direct materials costs were 621,600, so lower than budgeted. Actual direct labor costs were 198,000, so this is higher than budgeted. Actual variable overheads were 130,500, lower than budgeted. Actual fixed overhead was 285,000, higher than budgeted. So pretty much everything, every single number is different from budget. So as soon as you're given actual information, what you must do is then prepare an actual income statement, okay, and then put that side by side always. It helps, okay, against your budget, so that then you can start figuring out all your variances. So we are now going to prepare the actual income statement. Okay. So actual revenues, we have given 1.25 million. Now, one particular point, the stylistic point, but it's something that is very, very useful for you when doing this type of analysis, is every single component you have here in your budget you try to reproduce with your actual income statement. Okay? So we're going to try and put right on top of this number, we're going to try and break it down into the elements or into the components. Okay? So we know already that the actual selling price was what? 125. So what was the actual volume sold? 1.25 million divided by 125, or you ended up selling 10,000 jackets. Okay? Now actual direct materials cost 621,600. Now we do the same thing here. We try and break it down into its components. Okay? Now we already know this piece of information because we know from the top that we sold 10,000 units, right? So your actual direct material cost per unit must have been 621,600 divided by 10,000, which is 62.16 per unit. So as you keep laying out your numbers, keep breaking them down, okay? This will help you immeasurably in the variance analysis going forward. Let's do the same thing with direct labor and with variable overhead. Okay? So again, 10,000 units times our actual direct labor cost per unit must have been 198,000 divided by 10,000, or 19.8 per unit. And then finally for variable overhead, 10,000 units at an actual rate of $13.05 per unit. Actual fixed overheads were 285,000. Now, do we break this down? We do not break this down because it is fixed overhead, remember, and it's simply incurred as a lump sum. Okay? It's not incurred on a per unit basis, so it doesn't make any sense to break down this number into a per unit basis. So actual income, 1.25 minus 621 minus 198 minus 130 minus 235. I'm going to tell you what it is to save a little bit of time. 14,900. Okay. So now we have our budgeted income and our actual income, and best of all, we have both of them side by side. Okay, so now we're in a position to compare. You were expecting or budgeting to make 108,000 in income, but you only ended up making 14,900 in income. Now, any questions about either of these two statements before we move on? Okay, so now we're in a position to calculate our very first variance. Okay, and this variance we call just the overall income variance. It has a few other names which I will tell you as we go along. What is the overall income variance? What is the overall income variance? Right, 108,000 minus 14,900 gives you a magnitude of 93,100. Is that all? Just that classification you should try to make instinctively or intuitively, because you look at this as a good or bad, and it's really bad compared to that, so that makes it unfavorable. Okay? So you have to always remember, quote both pieces of information, because otherwise, you see, if you are the person who is receiving this information and your junior just told you that the variance was 93,100, imagine the first thing you would ask that person, is it a good variance of 93,100 or a bad variance? Okay? So this is our very first variance. Okay? Any questions? It has a couple of other names. I'll introduce those names as we go along. Any questions about the calculation of this variance? Now, suppose you were the manager in charge of this division, the jackets division, and somebody came and gave you this report. our final results have come in, and we have a negative variance or an unfavorable variance of 93,100, which is almost like 85% of your budgeted income. Okay, so it's very, very bad performance. Now, obviously, you're going to want to do something to correct it, to come up with a plan of action to correct it, right? So the first thing you're going to ask this person is, well, what went wrong? Now, in this example, can you point to one single thing that went wrong? Or is it a combination of many different factors? Is it only one thing that went wrong, or is it a combination of many different factors? It is usually always a combination of many different factors, right? What are some of the issues what are some of the things that went wrong, that didn't go as well as planned? We sold only 10,000 units, we're supposed to sell 12,000. That's huge, right? That has probably had like a first-order effect on your performance. What else? Or, another way of thinking about it is, every unit cost more in labor and actually also in materials and variable overheads than it should have cost you. Because you're supposed to spend only 60 on materials, you wound up spending 62.16, 18 versus 19.18, and so on and so forth. Right? So not only did you sell less, but every single unit that you sold also cost you more, so it's kind of a double whammy in that sense. What else? Yes, fixed overhead also went up by about 10,000, right? So it's actually 4 or 5 different things that went wrong. Now, if you want to come up with a plan of action as to how to fix this, clearly your first priority is going to be trying to figure out, okay, there's all these different things that happened, okay? And if I wanted to trace responsibility for each of those factors, you would trace responsibility to a different part of the organization, right? If something went wrong with sales and marketing, right? So then clearly you would trace responsibility to the sales and marketing agents. If something went wrong with your production, if your production cost more than it should have, clearly you will trace responsibility to your manufacturing or your operations people, right? You see that each of these issues is under the responsibility of a very different part of the organization. So you can only take action at the level of individual departments or individual people, and each of those departments or teams is only responsible for one very small part of the whole thing. So clearly, if you want to come up with a plan for action, you need to know how much of this unfavorable variance really has come from, okay, the sales volume being lower than expected. How much of this unfavorable variance has come from, okay, the direct material costs being higher than expected? How much of it has come from the direct labor costs being higher than expected, and so on? This number is useful, but it's not that useful because it only gives you what? It only gives you the combined effect of so many different things that have happened in different parts of the organization. Okay, so as a manager, your first task should be really to try and take this number, this unfavorable variance, and try to disentangle it or separate it into a group of smaller numbers, each of which represents what part of that variance comes from or is due to or is attributable to each one of those causes that you guys just listed out. Is everyone on board with that? Right? Because that clearly gives you, if you were to find out that, okay, 80% of this unfavorable variance is due to the sales volume issue, well then clearly that's your first priority, that's what you need to address, right? But if you found out, for example, that only 35% of that unfavorable variance is due to the sales volume issue, well then there are other issues obviously that have, contributed in large part to this poor performance. So suppose I have a very simple task to start with. I want to figure out how much of this unfavorable variance was due to the sales volume being lower than expected. Okay? How would I do that? How much of that unfavorable variance was due to the sales volume being lower than expected? Not any of the other factors. Okay? How would I go about doing that? Percentage of what? Like, what do you have in mind? So you do 10,000. So you do 2,000 divided by 12,000. So that's roughly like a 15% decrease. And you would say 15% of the unfavorable variance came from that. So the problem with that approach is you only are accounting for the revenue decrease. You have to realize because you sold fewer units than you expected to, your costs are also lower. So that's kind of offsetting the fact that your revenues are lower, and so your method doesn't take into account that. Okay. Any other suggestions? Actual cost or budgeted cost? Yeah. Okay. Okay. So that's a reasonable suggestion, right? You take that difference in sales, the 2,000, right, and then multiply it into all of your actual costs, and then that way you can figure out, okay, because we sold 2,000 less, this is the total income we didn't end up making, or something like that. So really what we're going to do is a variation of that approach, okay? And that variation involves the following. We construct a new budget that we call the flexible budget. Because this budget is called the flexible budget, we call this one the static budget, just to distinguish this from this. Okay, we construct a new budget called the flexible budget. And the flexible budget, everyone pay close attention. If you just remember this one thing, you'll never forget what to do. The flexible budget is the answer to the question, what would my static budget have looked like if I had known then exactly how many jackets I was going to sell, but no other piece of information about the future. Okay? What would the static budget have looked like if I had known then exactly how many jackets I was going to sell, but no other piece of information about the future? So the flexible budget only differs from the static budget in the units. Keeps all of the other information from the static budget. So I'm going to quickly construct a flexible budget for you. That's going to be your revenues, okay? 1.2 million. This is going to be each of your costs. Your materials cost is 10,000 times 60. Your labor cost is 10,000 times 16. Variable overheads 10,000 times 12. Let's put in all of these numbers. 1.2 million, 600,000, 160,000, 120,000. Now, what should the fixed overhead number be? If you had known that you were going to sell only 10,000 jackets instead of 12,000 jackets, what would you have budgeted your fixed overhead to be? The same number. Why? Because these are fixed overheads. They're not expected to vary by your actual volume of production. Okay? So now, let's suppose you figured out what this is. The flexible budget income is 44,000. Okay? Go back home and verify each of those numbers for yourself. Now I want you for a second to forget about this actual. Just forget it. Don't look at it. Only compare the static to the flexible budget. So static budget income 108,000, flexible budget income 44,000. What is this entire difference due to? The difference between the static budget and the flexible budget is entirely due to what? Due to the difference in the units sold, right? You all agree? Because we deliberately kept every single other component in the income statement the same, constant, right? So the entire difference between the static and the flexible budget is driven by the sales volume effect, or the fact that your actual sales volume is lower than budgeted sales volume. So this variance is what we call our sales volume variance. Okay? So what is it? It's 56 plus 8. 64,000 unfavorable is our sales volume variance. So really, out of the 93,100 overall variance, how much was contributed by the sales volume effect? 64,000 was contributed by the sales volume effect. Okay. So really, this is sort of the this is only the very first sort of stage of the variance analysis. We're going to keep on breaking down each of these variances that we see into smaller and smaller variances. Okay, when you put them together, you get a very nice picture of exactly what it is that went wrong and how you should take action.